Hello and welcome to Wall Street Vision, a show that explores investment ideas from the best investors in history. I'm your host, Vlad. This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. Every once in a while, there's special situations that happen in the markets that allow investors to make really good returns. Through my study of the best investors in history, I've realized that sometimes their big successful investments follow certain patterns. There are certain situations that can happen in a market that allow investors to buy stocks at a discount. I'm going to cover these special situations toward the end of this week's episode. Before I get into the nitty-gritty, I want to start off with a story. The story is about this guy, Glenn Ballman. You've probably never heard of him. Well, Glenn grew up on a farm in Moose Jaw, Saskatchewan. If you've never been to Moose Jaw, and I'm gonna guess that you probably haven't, that's a small city in Canada that's quite remote. It's a place with some genuine country living. Moose Jaw is popular for their natural hot springs, and funny enough, Al Capone used underground tunnels in the area for smuggling booze to the US during Prohibition. Greg Ballman was this hardworking kid with good grades. He was different than his classmates, and from a young age he had a burning desire to be wealthy. There weren't that many opportunities in Moose Jaw, so this quest led him to move to Western Canada. He settled down in Vancouver and worked at an internet service provider, and at the same time he started his own online business on the side. The business was an e-commerce platform where companies could sell stuff to other companies. It was called onvia.com. We discussed this concept of asymmetric opportunities in episode 3 of this podcast. Well, this was Glenn's asymmetric opportunity. He wasn't making much money in his 9-to-5 job, so he figured that if his startup worked out, he could achieve his financial goals. And if it didn't work out, he'd still have his 9-to-5 job, so there was lots of upside and a very small downside. This was the late 90s, and the Vancouver startup scene wasn't quite as developed as it is today. He couldn't get funding, and he actually got turned down for a Visa merchant account for his business. Glenn felt a bit deflated and wondered if that was the end of his wealth journey, but the burning desire inside of him was still there. So he moved again, this time to Seattle, and he hit the pavement hard. He networked like an absolute madman and got a bunch of legit investors to fund his startup. They went through some pretty quick growth, and within a few years the company filed for their IPO during the heyday of the dot-com era of the early 2000s. The first day they went public, the share price for the company tripled. After the IPO, Glenn's ownership stake in the company was worth around $940 million. He achieved his financial goals and got to be extremely wealthy. As with most dot-com companies in that era, onvia.com was not profitable. They had revenues of around $30 million, but lost around $40 million to generate that revenue. They had over 300 staff, so they were burning through cash quickly, and as we now know, the dot-com bubble soon burst afterwards. Fast forward to a year later, and by April 2001, Glenn had to resign from the company. He was 29 years old at the time, and his net worth went from close to $1 billion to around $6 million. $6 million 20 years ago was a good amount, but that definitely was a hard pill to swallow. The cool thing is that even while Glenn got all of that wealth, on paper at least, he didn't change his lifestyle. He still lived in the same apartment and kept the same way of living. So this crash back to reality didn't hit Glenn as hard as someone who would have started buying up Bentleys and Rolexes. I wanted to start with Glenn's story because it's a great example of markets not being perfectly efficient. Before I get into that, let's go over a few definitions. Essentially, an efficient market is a market where all stocks are correctly priced because stock prices reflect all available information. In a nutshell, this is called the efficient market hypothesis. According to this theory, stocks always trade at the right price, and you can't buy an undervalued stock or sell an overvalued stock. The theory says that you can't outperform the overall market by picking individual stocks. According to the theory, the only way to get a higher return than the stock market is to buy a riskier investment. An example of a risky investment in this case is, let's say if you're investing in an emerging markets country like India, for example. It's considered riskier than investing in a developed market like the United States. The efficient market theory suggests that your only way to get a higher return would be to invest in emerging markets companies instead of focusing on US companies. The efficient market hypothesis is pretty common in academic circles, and there's a ton of financial theory that is based on some form of this hypothesis. But there's quite a few big-name investors that disagree with this theory. Warren Buffett wrote an essay in the 80s titled The Super Investors of Graham and Doddsville. This essay is a great read, and it's still relevant today. In the essay, Warren talks about a group of investors that were all taught by Benjamin Graham, and these investors have outperformed the market over a long period of time. So according to the efficient market hypothesis, that would have to be attributed to sheer luck. But all of these great investors came as students of Benjamin Graham. So there's a good argument that the value investing he taught is the secret sauce that allowed them to beat the index. I feel that the markets have gotten more efficient since the 80s. Computers these days allow for faster processing of data, so it's reasonable to say that today, more data can be interpreted quicker, which means that it would affect the stock prices quicker as well. That broadly translates to more efficient markets, where the true value of a stock is reflected in the price that you see quoted for the stock. Warren Buffett's opinion is that markets are efficient most of the time, but there are certain situations that make markets inefficient. An inefficient market can allow you to get some great deals on stocks, which translates to higher returns. Efficient markets will generally reflect news pretty quickly. If you look at the biggest stocks in the S&P 500, for example, and there's a negative news item about a stock, let's say, the price would decrease pretty quickly. But this is not true if there's a negative news item about a small cap stock. It can take longer for the price to reflect that negative news. Value investors like Warren Buffett are always trying to find a stock and to buy it for less than its true value. The best hunting ground to get these sorts of deals is in inefficient markets. So let's go through a few situations that can lead to an inefficient market. 1. The consensus being wrong can lead to inefficiencies. This is something we talked about in podcast episode 6, where we discussed second-level thinking with Howard Marks. Acid bubbles can happen for lots of different reasons. The 08-09 housing bubble in the US was caused by a few things, but one of the big drivers was the willy-nilly lending standards that allowed people with little to no income to buy a house. The dot-com bubble is another example that shows markets are not always perfectly efficient. If you looked at the Nasdaq peak in 2000, it took around 15 years for the index to get back to that level after the bubble popped. Hindsight is 20/20, so I'm playing Monday morning quarterback here, but going back to the story about Glenn Ballman, you had to have some questions if the company has $30 million in revenues and it still lost $40 million, and its valuation is around $5 billion at the same time. Also, they didn't really have a clear-cut competitive advantage. So it does look like it was a pretty frothy valuation. However, the reason the stock price was so high was because people transacted at those prices. So definitely some people thought that this was a fair valuation because they chose to buy the stock at those prices. With the Glenn Ballman story, it's hard to say that the market was efficient at those crazy prices during the dot-com bubble. Maybe it was efficient in terms of the supply and demand of the buyers and sellers, but those prices were not an accurate reflection of what the stock should have been worth if you did an independent analysis of the true value of each one of those companies. Let's go through a few special situations that can make the market inefficient. 2. Illiquidity. Illiquidity is a fancy way of saying not enough buyers or not enough sellers. A market that doesn't have a lot of buyers can lead to inefficiency. If you don't have a lot of buyers and someone needs to sell their stock, the selling pressure will cause prices to decrease a lot. This can create opportunities to buy stocks at a discount. Illiquidity goes both ways, by the way. If there's not enough sellers, there's not enough shares to meet all the demand, so prices can go up drastically. If there's not enough buyers or not enough demand, prices can go down drastically. This happens in any type of market, by the way. For example, real estate would show the same sorts of tendencies. 3. Information asymmetry. That's another special situation. When you're dealing with stocks, you're generally dealing with companies that have a lot of information out about them. You can read the annual financials and get a good idea of the inner workings of the company. So it's likely that the buyer and seller of a public stock have access to the same sorts of information. Of course, there's cases where you have a huge institutional investor with an analyst whose sole responsibility and full-time job is to only analyze 10 stocks. And the analyst might be selling on behalf of the institutional investor, and the person on the buying side of that transaction might be an average person who just read a post online about the stock and liked it. That's an obvious informational asymmetry that can exist. But hypothetically, the analyst and the average person both have access to similar information. The average person can go and read the annual reports and industry reports that the professional investor has access to. In some markets, the buyer and sellers don't have access to the same information. Let's say if you're buying a house in a hot housing market like Toronto had for the past year, the seller of the house has a lot more information on the house. They know the neighborhood really well. They know if the house is prone to flooding or if there's been an increase in vandalism and crime in the neighborhood, for example. The buyer might not know these details, so there's this information asymmetry where the seller has more information than the buyer. This creates inefficiency, and it benefits the seller in this case. Sometimes the informational asymmetry can benefit the buyer. There's antique hunters that go through estate sale auctions and garage sales looking for antiques that are being sold for bargain prices. The person at the garage sale might have a plate from some sort of emperor of the 4th dynasty next to a bunch of their other useless junk. The seller might think it's a funny looking plate that doesn't match any of their dinnerware. The antique hunter that is an expert in ceramics can spot that amazing find, so in this case they have an advantage in their informational asymmetry. Translating this to stocks, it's good to look at insider disclosures for selling or buying stock by company insiders. An insider has to quickly disclose if they're selling or buying a stock. An insider is someone who is really high up in that company and they own a significant percentage of the total outstanding shares of the company. There's a popular quote by Peter Lynch that says, "Insiders might sell their shares for any number of reasons, but they buy them for only one reason. They only buy the shares if they think the price will increase." Peter Lynch with some great wisdom. If you're buying a stock and you see that the chairman is also loading up on shares, that's a pretty good sign. You would think that the chairman has some information asymmetry in this case because they can look at a lot more data from the company than you can. So if they're bullish, that's a really good sign. There's also a 2003 study from Harvard that found insider buys beat the market by over 11% per year, so there's some research to support this idea. There's a few websites out there that show this sort of information. FinViz and Guru Focus are two of them. I will say that it's not great to base your whole investment thesis on insider purchases, but it's a nice point to support your argument about a stock as long as it checks off all of your other boxes. 4. A forced selling situation is another example where inefficiency can happen in a market. Mike Berry described something like this in his quarterly Scion letter a while back. He talked about an institutional investor who disclosed that they're going to dump several weeks' worth of volume of a stock, essentially not caring about the price that they get for the stock. The stock crashed. Mike bought a ton of it, and then the stock tripled in about a month. And a month after that, the company was acquired for 7 times Mike's original purchase price. A nice return for Dr. Berry. There's lots of scenarios where forced selling might happen, and the really big examples will usually make news headlines. 5. Smaller companies and smaller markets. The notorious B.I.G. had a song called "Mo Money, Mo Problems." Well, when it comes to investing, that's definitely true. If you're in charge of investing $100 billion and your portfolio is going to be roughly 20 stocks, that's about $5 billion per stock that you've got to invest. So you're limited in what you can buy because your investing universe is just these massive companies. There's a ton of competition and analysis going on for those stocks, so their prices are going to be efficient for the most part. So it's way more likely to find inefficient markets when looking at smaller companies. If there's a small company that has a $5 billion market cap, the big investors won't look at it because it's too small for them. Well, that means that there's more opportunities to find undervalued stocks in those types of markets. And this is something that Warren Buffett has commented on quite a bit. Currently, he's managing a massive portfolio, so he can't look at these tiny companies as potential investments. He has to look at only the biggest companies in the world. 6. Little analyst coverage. If there's a massive spotlight on a company, people will generally come to some sort of consensus for what it should be worth. But if there's only a few analysts, there may be discrepancies in the conclusions about the true value of the company. If only 2 analysts cover a stock, and each of them is supposed to be the lead analyst on 10 different stocks, then it's possible that they would not be able to dig through all the important information about that particular stock. So their price targets can be off, which may be a good opportunity for a skilled investor if they're diligent and have good analysis. That's where you're more likely to find a diamond in the rough, or a stock that is deeply undervalued. To wrap things up, as Warren Buffett says, the markets are overly pretty efficient, but there's certain places where you're more likely to find inefficiencies, and that's where the great investors get above average returns. Inefficiencies also don't tend to last that long. It really depends on the type of inefficiency and the type of situation, of course, but as you can see in the Mike Berry example, the stock he wrote about was selling at a discount for only a few months. Monish Pabrai, who is another great investor, he's mentioned that inefficiencies can last as long as a few years as well, so sometimes investors have more time to act on an inefficiency. That wraps it up for this week's episode. Thanks so much for listening, and I hope you have a great day.